Hey, good afternoon, everyone. Marty Mazzora here, Friday the 13th of September 2024 with your weekly video update. Clients, you'll get this in an email tomorrow morning. It's little more than, or actually a little less than an hour before the equity market closed today. Been a very interesting week. Not a ton of data, but we've got some very important data. And next week we have the Fed meeting, which is absolutely the focus of the market at the moment. On your screen is that simple graph of our PWA, call it General Conditions Index. Last couple of weeks, it's actually improved a bit. We're at a negative 31 right here, but you can see the kind of the little uptrend we've had here. Still solidly in the area that says recession risk is too high to ignore going forward. So we're going to continue to do some of the defensive things that we're doing to try to mitigate the extent of a recession-induced sell-off in stocks. Stocks are historically overvalued really as a group. Now there's a lot of concentration in select issues within that group, but nevertheless, historically speaking, and I'll show you I think something here in a minute on that, stocks look very much overvalued in a recession scenario. They're overvalued relative to earnings and revenues as it stands, but obviously the price has been bid up in anticipation that the former will rise to the occasion that stocks or that prices are currently discounting. If that happens, great. And at that point where conditions make sense, we'll be happy to add some more risk to client portfolios at that time. But for the time being, that would not be the responsible thing to do in our candid opinion. Okay, so jumping to the screens, I don't need to take a whole lot of time. Consumer credit data came out this week, and as you can see, we had a massive move higher in consumer debt monthly change to the tune of $25 billion. That actually suggests that maybe consumers are confident and they're out there spending money. You can see they were very confident right before the COVID blip of a recession, pretty dramatic decline in equities. But we were in the recession camp then, actually from late August until it actually happened. Our signals were saying recession odds were relatively high. But again, nevertheless, if consumers are confident, they're out spending money and they're out there doing it in a big way currently. And as we've talked about, though, clearly it's concentrated in the upper 60% or so of the income distribution ladder. The bottom 40%, as I continue to tell you, appear to be quite desperate. And I think that is the case right here. So we'll see how all this plays out in the longer run. Total consumer revolving debt outstanding, credit card debt, a lot of people have talked about it at above the trillion mark now. We do have to put it in context as a percentage of household net worth, debt service as a percentage of disposable income in the aggregate really isn't that bad. However, having said that, 90-day delinquency rates on credit cards and auto loans are in the, quote, serious category, and that really reflects how poorly the bottom 40% of the income distribution is doing. So we'll see again how this all evolves. As you know, clients, we are concerned about what those statistics say about the go-forward economy. Now, consumer confidence continues to improve on a trend basis. Here's the Conference Board's Consumer Confidence Index. This morning, we got the latest from the University of Michigan. And just to kind of give you some of the detail on that, and this is the preliminary September reading. We'll get more detail as they get more detail or as they parse through what they have. It rose to 69 from 67.9. It was estimated to come in at 68.5. And again, while the trend is decent, as you can see, the level is not high, by any historical norm. But again, we're looking at the directional move as being important. One-year inflation expectations was at 2.7% versus 2.8% the month prior, but the longer-term view actually rose to 3.1% from 3%. Otherwise, the internals are mixed. Employment expectations fell to the lowest since June of 2023 and so on. So definitely not a robustly positive report from the consumer. However, not overall horrible. Doesn't say that the consumer is at the moment as a group feeling like we're on the verge of recession, but definitely there are some concerns, and the data tell us that that those concerns are warranted. In fact, let me just refer to the blog post, the written blog post from earlier this week. Those of you who might have missed it, and I'll just kind of highlight here. I featured comments by Peter Bookvar on the Fed Beige Book release the prior week, and this is where they go region to region and do their surveys, and I'll just go with his bolds. Economic activity grew slightly in 3 districts, while the number of districts that reported flat or declining activity rose from 5 to 9 in the current period. There are isolated reports that firms filled only necessary positions, reduced hours and shifts, or lowered overall employment levels through attrition. Consumer spending ticked down in most districts, having generally held steady during the prior reporting period. Manufacturing stays in a recession, by the way. That activity declined in most districts. 2 districts noted that these declines were part of ongoing contractions, like I just said, in this sector. Then this week we got the National Federation of Independent Businesses Small Business Survey release. The overall index fell by 2.5 points to 91.2, erasing the previous month's gain. It's the 32nd consecutive month below the 50-year average of 98. So we're far cry from 98 in terms of the overall optimism index. Uncertainty index rose to 92, its highest level since October 2020, and so on. Their chief economist said the mood on Main Street worsened in August despite some improvement in July. Historically high inflation remains their chief concern. Sales expectations plummet and cost pressures increase, yada yada. So again, not a rosy report by any stretch from the NFIB. I mentioned valuations a second ago, so I want to just touch on that because I did that here in the written blog. Hope you can see this okay. Price to earnings ratios are at historic highs. As you can see, I shade the area where it's above a level that we think is safe. Now, valuations are unequivocally the worst timing tools. You can stay overvalued by historical measures for a very long time. My concern is just how they typically resolve, and that is generally with some double-digit pain. And I want to talk about how we look long-term from these valuation levels. Price to sales, a little harder to manipulate, are just off of all-time highs, which were just before that 30% or so bear market in 2022. And here's the stock market amid massively high price to sales ratio. And then the price to book value ratio is virtually at an all-time high right here. And so is the stock market. So again, these are just not levels, as I keep saying, that would suggest to me, along with all the other macro evidence, that this is the setup that sustainable bull markets are made of, clearly. The so-called Buffett indicator, this one's a little slow to come, obviously, so this is back to June. We do know that Warren Buffett has made some pretty defensive moves in the Berkshire portfolio of late, but he supposedly looks at the size of the stock market relative to the size of the economy, and it sits at 202% of the economy. And you can see how the long-term chart looks there historically. Overvalued. Robert Shiller won a Nobel Prize for the cyclically adjusted price to earnings ratio work that he's done. It's historically very high, and in that area where we tend to get into trouble. And John Hussman, who I have a phenomenal amount of respect for in terms of his long-term, very unique valuation work, he said the other day, why did the S&P 500 total return lag Treasury bills in these periods? And why did Treasury bonds outperform stocks during all of these periods? And the answer is extreme starting valuations, which is what I'm talking about. And he yellow bubbled those areas on his chart, and you can see where we are currently. So whether we get a big breakdown or not, longer term, extended periods of time, we tend to get subpar results from U.S. stocks starting from these valuation levels. Does that mean there's no opportunities in the world going forward? Unequivocally not. Clients, as you know, we are quite bullish on several themes as the next cycle gets underway. It's just that our work right now continues to tell us that the risk reward right here and now is not favorable or conducive to adding risk. We can still make money in this environment, which we have, that we feel very good about so far this year, but we still do have our eye pretty firmly focused on defense. We may indeed get a nice Q4 rally. September has yet to play out. It's historically the only month of the year that you tend to get a negative rate of return, and typically that happens the second half of the month. But again, we have the Fed meeting next week, and I'm going to talk about some recent developments, let's say, from a sentiment standpoint about maybe what we should expect next week. Just to run through the rest of these charts I've loaded, initial jobless claims continue to move in the wrong direction. You can see when they're moving in that direction, we tend to end in recession virtually without exception. So we'll see. Small business index, we talked about that. Economic surprise indices, U.S. is getting better. So you can see we're still not positive, but little moving in the right direction. As for the rest of the world, European surprise index and so forth look like they're beginning to bottom out. So some data has been coming in better than expected. Japan's the only place in the world where expectations have been better than what economists had previously expected. CPI came out this last week. The headline dropped to 2.5% year over year, 0.2% month on month, still a bit above the Fed's 2% target, but they made it clear that as long as we're moving in that direction, they're happy. However, the core, when you take out the volatile food and energy, is still at a heightened 3.2 and moving at a 0.3% monthly clip. PPI came in pretty much as expected. That one didn't move the needle much for the market at all. Commodities are showing some signs of life here. The chart is bullish. We've got a bullish divergence. Here's the Bloomberg Commodity Index. This is kind of issues for the Fed. One thing I didn't load up here is the Baltic Dry Index. Tracks cost of shipping across the world's oceans. It's back up there at a pretty elevated pace as well. So going to be very interesting to see what goes on next week. A couple days ago, there was virtually no chance of a 0.5% rate cut at next week's meeting. However, as of this morning, quickly that's turned on its head. Now there's a 50% chance of a 50 basis point rate cut, 100% chance of a 25. That we're going to get at least. We may very well get 50. Now I want to show you a chart of the 2-year yield, the 2-year Treasury yield, which is a direct reflection of expectations on where the Fed is going to go with the Fed funds rate. Notice right here at about 1 o'clock Eastern time yesterday, the 2-year yield literally just fell off a cliff, right? What also very interestingly happened at exactly the same time is S&P 500 futures did kind of a bit of a moonshot, right? Which had carried over into today's session. But as you can see, we're giving up a little bit of steam right here. We'll see how we close. Right now, we're about 36 minutes before the close, and it's holding up. S&P is still up about 0.5% on the day. But again, big day yesterday. So what happened right in here? A gentleman named Nick Timmeros is a reporter with the Wall Street Journal, and his nickname is Fed Whisperer. He is the person who the Fed communicates through. Today's Fed has zero interest in surprising the markets. So he wrote an article that still offered up some ambiguity, but clearly was hinting that the market should not be too surprised if we get a 0.5% increase at next week's meeting. There was enough ambiguity that I think if they decide that it's going to happen before they actually meet supposedly and really formally talk about it, then early next week I suspect we'll get more of a hint. So I think we'll probably get more of a hint either way. A 50% chance of a double cut, which would be 225 basis points cuts or 50 basis points, is unusual. It's unusual that you have a 50-50 possibility this close to a Fed meeting. So I suspect there'll be a little more clarity. The stock market seems to want 50 bips. I actually think that's fine. Our view, again, is that things are likely to continue to deteriorate, and the Fed may even be behind the curve. Now, that's not everybody's opinion. There's one person I respect greatly who doesn't agree with our recession thesis, and he thinks they're making a massive mistake, and they're cutting way too early, and inflation is going to be a problem a la the early 80s. And that is a legitimate concern. I just showed you that commodities are kind of firming up. I talked about shipping costs and that sort of thing, and consumer expectations a little longer out. So that's got to be keeping them up a little bit at night. And that is that, here they are looking at making an extra cut when the stock market is just off of all-time highs. That typically is not what they do. But their narrative that suggests they should is that, inflation is falling. Real interest rates, therefore, are too high based on where the Fed funds rate is right now. Ex-Governor Bill Dudley just won't shut up about telling the Fed they need to cut by 50 basis points. He reacted to the so-called SOM rule, which measures the rate of change in the unemployment rate. And since 1950, once it's moved at a certain rate, the recession signal is triggered. And 100% of the time we've ended up in recession. Well, that's triggered now as well. So I think that's got his attention, and he thinks that the Fed needs to react like yesterday. So lots of dissenting opinions out there. Our job is just to measure the risk reward and invest accordingly. And I'll keep reporting to you. It's going to be very interesting as we go. Taking a quick look at just the stock market technicals. Apologize for my very busy chart. This is a 5-year daily chart of the S&P. Let me cut it to 1 year really quick. So the market is fighting mightily to get, once again, it's just a hair away from these all-time highs that we had right there. You can see we spent a good week plus bumping up against that resistance, ultimately losing it, losing the 50-day moving average, and then bouncing right back now. Flat 50-day moving average. This rolls over. Bad things tend to happen, but again, that all remains to be seen. From a momentum standpoint, it does not look good, folks. We have a very divergent high right here, and we're about to get another one. We do have a little buy signal here on the MACD, but we're more interested in the divergences in momentum. You're not going to wipe out these divergences here with a new high next week. So that suggests, at least here on the daily chart, that traders or investors should be wary, buying into perhaps good news from the Fed next week. Looking at a weekly chart, the weekly chart is troublesome to me. We're just coming off of overbought territory, as I've shown you on the extended chart, that typically you get more than this coming off of overbought conditions on the weekly chart, and we do have a very clear bearish divergence both in the RSI and then the moving average convergence divergence, and we've yet to recapture this uptrend line as we broke out of this rising wedge pattern. In terms of the NASDAQ, this would be a 5-year daily chart as well. Still pretty far cry from recent all-time highs, and there's very little in the supporting indicators that suggests that we should lean in that direction. As you can see right now as I speak, and let me zoom in on that. We are testing this trend line. You can see we failed that test so far today, and we'll see. So yeah, this would be probably an objective short entry for a swing trader who caught this bottom right here. You would be shorting it right there, and so far it looks like that's what people have been doing, is selling stocks against that trend line. We could get a nice bounce here. We've had I kind of doubt it today. Yesterday made more sense. There is an absolute plethora, if you will, of calls on NVIDIA and on the SPY, the S&P 500 tracking ETF, that are due today, and it's just incredible the amount of volume. The top 10 most active options contracts today are either calls on NVIDIA or on SPY. Now, folks, we've been through this several times, but when a call is purchased, the dealer is then short the call or exposed to the upside. It's their liability. So the dealer firm buys the underlying security or some derivative of that, and that just feeds the upside momentum. This isn't out of bullishness, this is out of defensiveness. So you have to be careful when a whole bunch of those calls are expiring all at once, because then those long hedges, the stocks or the derivatives that the dealers bought, will then get sold. Now, it doesn't mean that NVIDIA and the market needs to come crashing down. There could be many, many optimistic call buyers, particularly when the Wall Street Journal suggests that maybe the Fed's going to cut 50 basis points next week, and right now that would be viewed as bullish. Well, then, it absolutely could go on without a hiccup. But just know that if we get a flip in sentiment, and we've got so much concentration in the options market going in the other direction, well, then that can lead to some pretty precipitous falls in the market. And again, more momentum to the upside would be people rushing in, buying more of those calls, dealers having to hedge, and next thing you know, we've broken right through that downtrend line, and the next stop would be right here on the Qs, 485. 100% that could happen. As you can see, there's some not small resistance to be had right there. But is it possible or likely that we get up here and at least test these all-time highs? 100% it's possible. My gut feeling is maybe I wouldn't go so far as say likely, but I don't think there's any reason at this moment to be hugely pessimistic. You've got some bad seasonality coming up, but I think until the market gets back into, and that's really what kind of forced this, was recessionary data. This is the belief that the Fed's going to rescue it. I've given you the history of that, and it's not something that makes you feel very comforted. So if this is going to be not different this time, well, then it's when those recessionary forces really kick in that you see stocks trade down to reflect the earnings reality that occurs during recession. So anyway, folks, again, so what am I saying? We don't know what tomorrow holds. When you look at valuations and you look at general conditions and you look at the fact that we're late cycle, I don't think you'd get excited about the prospects that we are about to enter a multi-year bull market in stocks. I'll stop rambling there, folks. Thank you, as always, for watching and listening. Talk to you again next week. Bye-bye.